In this video, we look at examples for Chapter 6 at Principles of Accounting 1. In Chapter 6, we talk about internal controls and cash management. So this first list of questions asks us what are these strengths or weaknesses in an internal control? Okay. So first, we're going to go through each one of them one by one and discuss whether or not they're a strength or weakness, and then talk about why. So first, number one, if a sales clerk makes an error in recording a cash sale, she can access the register's electronic record to correct the transaction. This is a weakness. So this means that there is no control in place that prevents her from correcting transactions or making changes to transactions without someone else looking at them. Two, all sales transactions, even those for less than $1, are recorded on a cash register. This is a strength. We are making sure we have good documentation of every single transaction. And by recording it on a cash register, we have records within the cash register. Okay. Next, two employees are tasked with opening mail that contains cash receipts. This is a strength. So if you remember, this was actually one of the examples given in Chapter 6 as a way to provide internal control. Number 4, one of the two employees tasked with opening mail is also the record keeper for the business. So this is a weakness. So this is a weakness because part of internal control is removing the record keeping from the cash management. So if we're opening mail, we're looking for checks in the mail. And so with an internal control system, that shouldn't be the same person. So the same person who collects the checks should not be the one who records the checks. So the supervisor has access to both cash and the accounting records. This is a weakness. This means that they can, again, change the accounting records and the amount of cash without any oversight. Receipts are given to customers only for sales that are above $20. This is a weakness. This means cash can disappear from your sales register, and you could say, well, there was a transaction less than $20. So this means that you're missing documentation of sales. Okay, so now let's look at these cash payments. So one, a voucher system is used for all payments and liabilities. This is a strength. This was also one of the examples of an internal control strength that was given in the chapter. Okay. Two, the owner of a small business has authority to write and sign checks. Okay. So this is a strength. When looking at strength or weakness, it's not even necessarily who has it would be, so who's recording them in the accounting records. That's where we would be looking for the weakness. Uh, so this is going to be recorded as a strength. 3, when the owner is out of town, the record keeper is in charge of signing checks. Okay, so this is actually a weakness. So you would think, okay, well, we're just adding those duties to someone else, but what it doesn't do is separate the record keeping from the signing of checks. And that's what the importance is the separation of duties. To save time, all departments are allowed to incur and record their own liabilities. This is a weakness. So again, record keeping needs to be separated. Payments over $100 are made by check. This is a strength. Checks are documentation, proof. And requesting and receiving merchandise are handled by the same department. This is actually a weakness, and it's separation of duties. So requesting merchandise and receiving merchandise should be handled by two separate people. Okay, so now let's look at these five separate cases involving internal control, and then we're going to talk about which internal control is violated and what should be done to improve internal control principles. So A, a company keeps very poor records of its equipment. Instead, the company asserts its employees are honest and would never steal from the company. It's really great to have trust in your employees, but the internal control violation here is the requirement to maintain adequate records. It's important that we have good record keeping. That's a control, monitoring activity. Um, we are vulnerable to misuse, theft, loss if we don't have good records. Okay, so B, a theater has a computerized order taking system for its tickets. The system is backed up once a year. Okay, so the internal control we're violating here is the technological controls. That system needs to be backed up more often than once a year, and we need to have information on where that backup is stored. Okay, so C, a company has two employees handling acquisitions of inventory. One employee places purchase orders and pays vendors. The second employee receives the merchandise. Okay, so this is dividing responsibility for related transactions. So it sounds like the stuff is divided between two employees, but these activities should be divided between three employees in order to have full purchase control. One placing the purchase orders, one receiving the merchandise, and one paying for the merchandise. Okay. The owner of Company A uses a check software to prepare checks, making it difficult for anyone to alter the amount of a check. Good. The software, which is not password protected, there's the problem, is on the owner's desk in an office that contains company checks and is normally unlocked. Um, so this is also applying a technology control where all systems should be password protected, and only people who need access to them should have access to them. Okay, and then the last one, to ensure the company retreat would not be cut, the manager at Company B decided to save money by canceling the external audit of internal controls. Okay, so the violation here is the requirement to perform regular and independent reviews about how we should check our internal controls. So we need regular independent reviews to make sure that our internal controls are working and we're not exposing ourselves to risk. Okay. The last example is a bank reconciliation, which the end of chapter 6 talks about bank reconciliation. So bank reconciliations are very important parts of accounting transactions and accounting records. So it's quite possible if you ever went into a job in accounting that one of your duties would be preparing monthly bank reconciliations. Bank reconciliations are necessary for a part of cash management. So we have information about this bank reconciliation here. We have that on April 30th, we had two outstanding checks. So 1771 and 1780. Now only one of those is outstanding. So you can see down here that 1771 was recorded in our bank on May 1st. We have also various information from our bank statement here, information from our accounting records, and then we have other information such as check number 1788 is correctly drawn for $654. However, in our accounting records, we accidentally recorded it for $644. We have a non-sufficient funds check that was originally received from a customer and came in of their account. And the credit memo is from a note that the bank collected for the company, and we haven't recorded the collection yet. We're looking at this information here. We start with the bank statement balance, which we get off of our bank statement. So we have the current balance on our bank statement, and then our accounting which balance, which is what's currently the balance in our cash account. So that's what the book balance is. Okay, so we've recorded that. Now we're going to start on the bank statement side. So on the bank statement, we add a deposits in transit, so outstanding deposit. We subtract outstanding checks, and then we add or subtract any bank errors that happen on the bank side. Okay, so the first thing we're going to do is look at deposits. So we have information, so we have these 5 cash deposits that we recorded in May, so in our accounting records. And what we want to do is we want to look at the bank statement and see if all 5 of those deposits are recorded. And we see that that May 31st deposit has not been recorded by the bank yet. So that is an adjustment to the bank side. We have this May 31st for $2,727.30. Just going to format all of that dollars. Okay. We don't have any other outstanding deposits, so now we can go to outstanding checks. Okay, so it already told us that check 1780 is outstanding, and the amount for that was $1,425.90. So now we need to look at our accounting records and our bank statement to see what other checks are outstanding. And you can just look one by one. So 1782, 1783. Nope, both of those are there. There's 1784, 1785, 1787. We can see that 1786 is not here. So we know that 1786 is outstanding. 1786 for $353.10. And then the other one outstanding is 1789 for $639.50. Okay. When we add deposits and subtract outstanding checks, then we get our adjusted bank balance. We're going to take our current bank balance, add the deposits, and then we're going to subtract all of these outstanding checks added together. And we get an adjusted bank balance of $22,071.50. Now we want to make adjustments to our book side. So the first thing that we're going to do is we're going to what we need to add. So we have the proceeds from the note. So it told us in our information that we have this note that was collected by the bank of $7,350. Okay. Now we want to look and see, is there anything else that we need to add? Nope, this is a subtraction, that's a subtraction. Okay, so now we need to deduct, and we have a list of things. So first, we have this error check. So let's look at check 1788 that was returned for non-sufficient funds, or the error. So we have 1788 that was on our bank for $654 and is our accounting records for $644. So what we need to do is we need to make that $10 adjustment. So it's not the amount of the check or the amount recorded, it's the difference to fix that. And so it's a $10 adjustment. The next thing that we have is that we have a return check. So we have this non-sufficient funds check here on May 18th that was returned, $431.80. So we have a non-sufficient funds check for $431.80. And then the last thing we need to look for are any other errors or just bank fees. Well, we see here on May 31st, we have a $14 service charge for this account that we need to record. So we have a service charge of $14. Okay, so now we have our adjusted book balance. So we're going to take our beginning book balance, add the proceeds from the note, and then subtract the sum of our changes. And we get $22,071.50. So these two numbers have to match. If they don't match, then there is something wrong with your bank reconciliation. Okay. The last thing that we need to do is the journal entries to adjust the book balance of cash to this amount. So we need to record these four things in our accounting records, and we need to make journal entries for them. So we'll start with the receipt of the note. So we received cash in payment of a note. So that would have been a note receivable now that we need to debit in order to reduce the amount paid. So we have 7,350 and 7,350. The next adjustment we need to make is for the non-sufficient funds check. So we need to put that back into our accounts receivable because it was a payment for this customer W. Sox's payment. And then we need to credit cash because what we did was we recorded that he had paid that amount and it got returned for non-sufficient funds. Next, we have this error, and it tells us in our information that that was made on a utilities expense. So we need to add $10 to utilities expense and remove $10 from cash. Okay. And then last one is recording that $14 service fee. So we have miscellaneous expense for $14 and cash out for $14.